CF benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
Everything on this show is for informational and educational purposes only. It is not investment advice, and nothing we discuss is a recommendation to buy, sell, or hold any asset. The views are our own and do not represent CF Benchmarks, Kraken, or any affiliated firm. Any price targets, valuations, or models we mention are illustrative and not forecasts. The participants and their firms may hold positions in the assets discussed. Digital assets are volatile and you can lose your entire investment. And some products we reference may not be available in your region. Always do your own research and consult a qualified financial advisor before making any decision.
Good morning, everybody, and welcome back to another CFB Talks Digital Assets Live. My name is Gabe Selby. I'm the head of research at CF Benchmarks, the leading digital asset index provider. I'll be your host today. Along with me, as always, we got Mark Pilkoczuck, a research analyst at CF Benchmarks, Tomas Perfumo, the chief economist at Kraken, and joining us in a few more minutes, Peter Stern, our head of business development at CF Benchmarks. Our special guest this week is Craig Shapiro, the senior macro strategist at NinjaTrader. Today, we're going to be talking a lot about some market structure dynamics. Craig's got a really excellent Substack blog where he just recently posted about it. We're going to talk about some price action that we're seeing in markets as well, along with what's going on with the oil prices rising and all the geopolitical uncertainty. I want to give Craig a quick shout out before we begin and a chance to introduce himself. Our audience may know you from your Substack, but they may also not be as familiar with you as with your day job at NinjaTrader. So if you could give us just a quick overview of what you do at NinjaTrader and also the projects that you're involved with.
Yeah, guys, thanks for having me. But I've been an investor, trader, analyst, portfolio manager for the last 25 years or so, working mostly on the buy side, various large hedge funds over the last couple decades, and then more recently, I've kind of been managing my own personal capital and trading on my own, and then decided to take a job as the strategist at NinjaTrader, which is the largest futures broker in the country for retail trading. So I am on the morning show with Anthony Crudelli and Shy Girl, who does a lot of the energy and commodity stuff, and we're on every day on where we are streaming live on YouTube, and then I host a show on the weekends, a market prep show called the Sunday Open. I also write a Substack. I'm pretty active on Twitter, and like to mix it up, with whoever and anyone else who wants to talk about markets. And so, but yeah, I've been doing this for a long time, and now I'm just trying to give back and try to help out the retail trader with some analysis and understanding of markets, cross asset markets. I look at all asset classes and try to provide a holistic perspective on markets and try to help folks make money trading these crazy markets.
These markets have been certainly crazy. It's like a drama series that, I don't know, it just gets more interesting as time goes, especially if you follow it at the deep level of detail that I'm sure you do. So yeah, everyone, be sure to follow Craig and jump in on that NinjaTrader Live. So it happens every morning at what time?
Yeah, so NinjaTrader live streams all day long. We host live traders who are trading various commodity and futures markets throughout the course of the trading day. But in the morning, from 8 to 9, we have a morning show where we got to do a market overview, recap, have an interview, have a guest on. And so, I'm on it every morning. And then on the weekends, we host a show called the Sunday Open at 6 p.m. on Sunday nights, where we do market prep. We're also kind of evaluating the weekend news and what's going on, as the tape kind of opens up on Sunday nights. So,
You just get those Asia Open right there. Well, there's just a lot that's happening. I'm going to give a quick kind of hook on where the market's been trading. So Bitcoin's trading at 656, or approximately. It reclaimed the line that we had on Tuesday, and it seems to be holding up with a firm bid through these earnings nights that we've had. I think oil and rates is really the most pressing thing that we're seeing this morning. Brent is at $98, and I think we're seeing rates just continue to climb, trying to price in what could be another respike to inflation, given the another acceleration in the geopolitical uncertainty. I guess I should be honest with our audience. If we see a 98 handle on oil, like we're seeing this morning, this is going to make life hard on our own peak rates disinflation call that we just had in our outlook. But that tends to go with the way publishing quarterly outlooks goes. Is as soon as you make your calls, headlines start to make your calls look a bit outlandish. But I want to jump over back to Craig, your most recent blog post that you had in your Substack, where you talked a lot about implied correlations and kind of like this this coiled spring effect. Would you mind giving the audience just a quick overview of what implied correlations are, how do we measure them, and where are they today?
Yeah, I mean, basically, what I had done was kind of look back, and there had been some folks who were looking back to this period in the summer of 2024, where we had kind of yen carry trade unwind in the back half of July, and we saw a pretty violent equity market correction and risk off asset event. And basically, one of the precursors to that was also a similar fall in implied correlations, which is basically just kind of the way it moved together amongst the largest stocks. And so, if stocks are kind of all moving together, correlations are higher. If stocks are moving around in different ways, correlations are lower. And so what we've basically seen is kind of a very large amount of capital that's pushed into these kind of long single stock vol and short index vol type strategies, these dispersion strategies. And so what it's evinced itself in is a market that sees crazy under the hood stock movements, plenty of stocks up on a day, down on a day, and then underlying indices are not really moving all that much. And so the implied correlation between stocks in the indices continues to fall. And there's been again, a lot of capital that is moved into that arena. And so over the course of the last several weeks, we've seen implied correlations among these stocks kind of fall to, really almost record lows. And so, you can kind of see that on a daily basis, right? On a day when there's an idiosyncratic single stock story in, any particular large cap name or any particular sector, the semi sector or in software, you get a lot of capital that flows into that sector and then out of the other sector. And so, or days when small caps are underperforming, NASDAQ is outperforming, or vice versa. NASDAQ is outperforming, small caps underperforming. So you see a lot of this dynamic in play. And it gets to a point where it really just can't move any further. And so I think it's really indicative of just the excessive amounts of leverage that continue to fly into a variety of different strategies and try to pick up incremental yield, and plenty of systematic strategies that picked up on this, and the low net community, multi-manager pod community trades in this way as well. And so we've pushed into levels that have really stretched rational behavior, and kind of in the 99th percentiles of oversold and implied correlations. And so when I see that, I'm trying to figure out, what are the potential catalysts that could force investors to go the other way? What are the things that may happen? And typically what happens is once we start to get a little bit of a move in volatility somewhere else in the world, that has a tendency to start, eventually back up into correlation and beta moves in the equity indices. And so that's what I kind of wrote about a couple of weeks ago, just, trying to identify, didn't exactly know when this was going to happen. It happens to be happening right now. but it's we're finally starting to get into a point where we're getting a little bit more of a correlation spike. And I think what's happening here to what you mentioned at the onset, which is you're seeing a pickup in oil volatility. You're seeing a pickup in oil in oil prices because of the geopolitical concern. Obviously, rates are moving back higher again with more velocity. The MOVE index is starting to move. Interest rate volatility moving higher. And so, higher rates, higher oil, and then the last one is higher dollar, which is really starting to filter through. And again, today with accelerating speed, higher dollar, higher yields, higher oil, typically not a recipe for risk asset strength. And so I think over the course of the last few days, we're starting to, see that filter into the equity market. And now that we're through the options expiry window for July, much of the supportive positioning that exists towards the end of an OPEX calendar period, which we saw last week, dissipates, right? And so dealer positioning is at the cyclical lows for the month and the few days after expiry, and particularly the day after VIX expiry, which was yesterday. And
Yep.
so now markets have the ability to trade a little bit truer. Jem Carson likes to refer to this as the window of potential weakness. And I think that makes a lot of sense. It just means the bar for news to matter, for cross-asset news to matter to equity markets is lower when the window of potential weakness is open. And so I think that's what we're seeing now. We're seeing a catch up here. So all the things that you identified that have been going on, higher yields, higher oil, kind of up until last week, that matters more now when a lot of that supportive positioning is behind us. And so I think we're starting to see a larger, more protracted move, and volatility starting to move. Today I mentioned correlations are starting to move, and now we're finally starting to get a little bit more of a sell-off, which I think many probably believe we should have had already. But now we're starting to, now it seems like we're starting to get it this week.
Yeah, if I zoom out on NQ and ES, I see that we're finally starting to kind of break down below that channel that we created in early May. So the timing of this conversation is actually pretty impressive. The way this is all lining up, and yeah, we had VIX expiration yesterday. It's a great point. Um, I think there's just so much that you just said that I want to dive into, but let me just kind of take a step back. So we've got VIX, which is our headline index of implied volatility trading, let's say around 18, 19 right now. Kind of coming up, definitely from the 15 level. That's traditionally very, very low, towards kind of like a medium range. The implied correlations within the index, which is what we refer to as these individual names, implied correlations. If you were to take the strip of tickers and look at their implied correlations and just see the variance between those, that's really where we're measuring that systematic structural like low that we've seen being compressed like a cold spring. You talked a little bit about this, but what intra-sectors or what sectors or industries are you seeing as far as where you're seeing the most dispersion, or have you looked at that?
I mean, I think it really evinces itself in a large way in the semis versus software trade. I think that's a kind of a large like reflection of the implied correlation. So much capital had pushed into the long semi trade, just given all the thematics there, given the CapEx, plans by the hyperscalers, capital rotating into the memory names, the fab names, and the like, and the structural headwind stories with regard to the software names and the SaaS names. And so that semis versus software, I think, is just a reasonable reflection of kind of this correlation. And so folks are able to kind of put on. If you think about the low net strategies, the Millennium, Citadels of the world, these guys have to run with extremely low nets, low betas, and so they're often looking for these cross sector relationships that allow them to remain beta neutral and factor neutral and volatility neutral. And so they're able to flock into these long or these sector dispersion types of trades in order to kind of, I don't know, get around the risk tolerance metrics. And so tons of capital has flowed into that. And so I think that's probably the best place that you see that. But, on any given day, yields are up. You get utilities down, staples down, healthcare down, and some of the other names are up. Energy's up, you get energy up, airlines down. And so whatever's moving in the markets from a cross asset perspective, whether it's rates or commodities or whatever, then the underlying, or if there's an idiosyncratic story from an earnings report, typically what you're getting capital moving into those names that are in favor that day, and then out of names, and then the next day it could be completely flipped. And I think I think maybe the most frustrating thing is that overall for the S&P, folks who trade S&P futures, like this thing isn't moving, right? It's really just kind of range bound. And really what's going on there is that all the capital that flows into structured products, into zero data expiry options, that flow overwhelms everything else on any particular given day, and particularly on days where we're in the week of or week before expiry. It's just those dealer buybacks and those hedges being bought back kind of just overwhelms the idiosyncratic stuff. And so what winds up happening is the S&P stays pinned, but under the hood, violent dispersion, violent sector, intra-sector volatility. And so for folks who are just futures traders, they're like, this isn't moving. The S&P is not reacting to the news in the market and news in the economy. But really, it is, right? And then what you get is after that supportive positioning is moved behind us, then you have the ability for the indices to move a little bit more freely, which I think is what you're seeing, on a day like today, where all the stuff that we're talking about today, this was all known, right? Yields have been going up for a while. Oil's been going up for the last 3 weeks. Dollar's been rallying. Dollar yen is making 40-year highs. I mean, this is nothing new. It's just a lot of that supportive positioning now is behind us because of expiry, and so we get the potential for a more correlated beta move on a day like today, a day like yesterday, and probably for the next couple of days until the president decides that he's going to figure something out in the Middle East, and then then we'll probably have a beta move the other way, but it'll still be a highly correlated move at that point because we've stretched those relationships at such levels that you really can't get any more out of those trades.
Yeah, I mean, for me personally, you touched a little bit on the earnings story and the specifically with the tech sector. I was a bit surprised, looking at the headlines this morning, and also I was listening to Bloomberg Radio yesterday afternoon after Alphabet reported their earnings, at the realization that people are coming to with the fact that these hyperscalers are starting to go into negative free cash flow, right? You've had Google had positive free cash flow for I don't know, over a decade or something like that. And now you've seen with all this capex carrot, leading the stick type mentality where they've committed hundreds of billions of dollars of capex. That's actually starting to kind of bleed into the fact that they are negative cash flow. I'm not sure why people were surprised by that or why that narrative is really starting to pick up, but it's something I tweeted about earlier today. I think it's just getting started. And to your point about these higher beta moves, one thing that kind of was interesting for me, at least when we started the re-escalation in the Middle East in these past few weeks, was kind of the slower slope of Brent crude, then finally leading to like a more aggressive moves in the past few days, right? It was like I think we were hovering around like in the 70s, then we jumped up to 80, chopped around a bit around 85, got stuck there for a little while. None of the tensions seemed to be really dying down, but the market wasn't really kind of giving you that really displacement move up that we saw in the first, as soon as we saw like the war kick off. And it's not until like this morning, I feel like when we traded up into 98, that's a really big move. Do you think that this is kind of, so you're saying that now that we're getting through this these options expirations, we should just expect more and more of this essentially?
Yeah, I mean, basically, if you think about like all, or most strategies or most asset classes and market beta is short interest rate volatility, and it's just kind of short volatility. And so once you get a move in volatility somewhere in the world, if it has the ability to have follow-on impacts anywhere else, then you kind of suck in the leverage that exhibits itself in those asset classes, and the vol moves up there. And so I think you're right. I think the oil market was kind of ground zero this time around. It's like oil volatility was, had come down nicely, over the course of the last, several months as the president has tried to talk down the oil price and how we, weren't really doing much in the Middle East. And so kind of the oil VIX went from well over 100 down to, basically 40, like 2 weeks ago. Right. And so,
That's wild.
and over the course of the last, few weeks, it started to move up again. But you're right. In the last 5 days or so, we've really started to see, 7 days, we really started to see a big move up in the oil volatility. What does that lead to? That leads to kind of concerns about Japan's ability to import energy and what's going to mean for inflation there, and Europe's ability as well. What's the ECB going to do? And so then you've started to see that filter into rate volatility. And so as a proxy, like the move index also had been on the floor. And then now over the course of the last, few days, it's starting to move higher again. Right. And so then you start to move into the equity indices, which is kind of actually before equities, then you start to move into credit. And this kind of gets into what you were talking about with the AI CapEx names. If you look at the credit default swaps on something like Oracle, they've really blown out over the course of the last month or so. They're, for the 5-year strip, they're over 200 basis points now, kind of moved like 60 basis points in the last 4 weeks. Credit spreads on all the hyperscaler long-term bonds now are at the wides we've seen for the year and starting to move out. I think there'll start to be questions about whether or not Oracle should be downgraded from investment grade to high yield, given that spreads there are now kind of below where you'd see for kind of traditional double Bs. And so, Oracle's a massive debt player at this point. And so you're seeing a pickup in credit volatility. And then last but not least, finally, a little bit of a pickup in equity volatility, right? And so that's kind of the icing on the cake. And as you start to move and start to get volatility moving higher, then you're more likely to get beta moves, highly correlated moves. And, given the time of the month after expiry, this starts to matter more, right? And so I think that's kind of where we're sitting right now. Is this going to turn into something like we saw, at the end of July, early August 2024? Possibly. Is it going to be something bigger than that? It could be. I think it really depends on, the Fed meeting next week. What do they do? What do they say? There's a BOJ meeting next week as well. There's Japanese inflation print this evening, which could matter for the BOJ meeting. So you start to have these economic actors that could help either accelerate or stop the movements in volatility. Central banks, government treasuries are typically, OPEC. Those are the types of economic actors that could that stop this. And so right now we are moving into a period where the Fed up next week will be a very interesting meeting. What are they going to do? Are they going to raise or not? Should they raise or not? I think these are, what are they going to do beyond the July meeting? That'll help determine whether or not this move becomes more violent and we start to see a real asset price correction, or is it just a little bit of a shake up in here? Correlation spike kind of gives out, some of the leverage comes out, and then we just go back to doing what we've been doing all year. Well, I think time will ultimately tell.
Yeah, the AI CapEx story and some of the returns on that are actually quite interesting to me. I was looking through Google's earnings report, and they've reported, Google Cloud's up about 4x year on year, doing about 8 billion in earnings. But when you look at their CapEx plans, they're guiding 190 to 205 billion in CapEx for 2026. So if you thinking about the payback period on that, that's many, many years. And if we just look at all the advancements that have been going on in AI and all the changes with spend, it's tough to say, like, are they going to be able to even make a return on that over, the 6, 7, 8 years it could take to reach payback on that stuff. And that seems to be what's leading a lot of the indices lower today. It's, Google's down off about 7% last time I looked. And the other thing is, like, the indices are so concentrated in these hyperscaler names because these are all multi-trillion-dollar companies. So you get a move there and you just really see it start to act as a drag on the headline index.
Yeah, look, I think it was a seminal moment for the industry when, last September or so, when Oracle did the big debt deal, and I think another one when, last month, I think it was the beginning of last month, or it was the end of May, when Google announced the equity deal, right? I mean, we basically moved from internally generated free cash flow to fund the AI CapEx build out to increasingly debt to fund the build out, and then kind of the biggest name in the industry, one of the best, most profitable companies in the world is like, you know what? I'm gonna sell equity here in order to fund CapEx, right? I mean, it's can you blame them? I mean, stock trading at a huge multiple.
No.
Stock trading at a huge multiple. Like, these guys are smart, right? They're calling a top in the sector. They're calling a top in their valuation, and they're saying we know OpenAI needs to raise, and Anthropic needs to raise, and all these guys need to raise. We all need to raise. Like, we're going to use our equity as currency here to raise a shit ton of money and make sure that we are the CapEx winner in here for the next 10 to 20 years, right? And so, as an equity investor, should have been a reasonable red flag. And I think you're right. Plenty of charts going around today about Google generating negative free cash flow in the quarter, and it's not going to look any better next quarter. And so, you have to start thinking about what does that mean for funding of CapEx for the entirety of the sector, particularly the names that are not as strong, that don't have the ancillary revenues and profits like Google does. And you're right. I think that is the market coming up to some collective wisdom today about that? Probably not, but certainly it's developing in the psyche of the market. At the same time, you're getting dollar yen towards 164, 30-year yields moving higher towards 5.2%. Oil up 7%, right? You're getting a lot of big moves cross asset wise that I think are going to force investors who have been largely risk on from the ceasefire talks at the end of March, early April, to say I think I got to take some chips off here.
Thomas, I wanted to bring you in. if you have any insights here on these things.
No, you guys have done a good job summarizing all of my thoughts, really. I think the only thing I'll add, I guess, to the mix is uh, the there's some interesting, I guess, anecdotal evidence. When you had OpenAI and Anthropic rumored to be postponing or delaying their IPO, I don't know, probably like a month ago or so. It's been kind of weak since then. I think that was kind of a harbinger of people seeing the conditions as they are. I really agree with the comment from Craig about the equity raising, and there's this component to it, which is companies like Google, Amazon, Meta, et cetera, that have a cash flowing business. They have much more free access to credit markets than a company like Anthropic or OpenAI, even if you ignore the fact that they're public companies. And so, from what I've heard, the rumor is the bankers are basically advising them, hey, like this is the time to raise equity, compete for the equity while it's here before it goes to a lab like Anthropic. You can always access credit afterwards. They cannot. And so I do think that there is that kind of like short-term pressure that's going to come in the equity markets for these guys. And to Mark's point earlier on the CapEx side, one thing, and I think Greg alluded to this too, um, they're not straight lining the CapEx spend this year. It's actually going to be accelerating over the next couple of quarters. And so the free cash flow numbers are going to come under increased pressure going forward, and I think people are kind of trading ahead of that. But
How,
it's a super volatile
how
condition and very binary as well with the geopolitical stuff.
good point on the acceleration. How likely do you think the acceleration comes to fruition?
I mean, they didn't, it doesn't seem like they made any modification to the guidance, so that tells you one thing. But it's kind of we keep entering these like lose-lose situations, because what's the first thing people are going to think about if Google says we're revising our CapEx numbers lower? They're going to start questioning the conviction in AI spend
I,
altogether.
I think
Uh,
personally, as soon as you see someone revise their CapEx spend, and the market starts to reward it, that's the next signal here. So, like Craig, you did such a great job basically sequencing the playbook of how we got, an oil market vol shock that led to rates vol. Now it's bleeding into equity vol. And that's the sequence, right? I think the sequence here with this narrative that we're seeing with AI is, look, you've got all these things that you were talking about, Craig. You mentioned how they were, financing all their CapEx through free cash flow. Now they're doing external messes, whether it's through the equity issuance or the debt issuance. I just pulled up some numbers here for the tech sector buybacks. Here's another sequence. Total buybacks in the S&P IT sector in the last 12 months, $215 billion. Last 6 months, $71 billion. Last 3 months, $0.9 billion. So they're decelerating their buybacks. It's clear like this is getting expensive. And so they're very much, last week we are also talking about on the show how the comments of management starting to question token expenditures on their AI plans. They're trying to either do audits or maybe give people fixed budgets, but the days of just letting people loose and spend a bunch of money on their token plans, it's kind of coming to an end. And so how this all bleeds into the sequencing is you start to see maybe the capex get revised lower, the market rewards it, and then how do those hardware, the RAM companies, how do those react? And I think that's going to be, for me personally, a very, very like interesting thing to see how that plays out.
Yeah. Another thing I've been watching kind of closely too, and this goes back to the point of the yields rising, is forward earnings yields on the headline indices. So the S&P 500. If I've got trading at around 20 times forward on the terminal based on consensus estimates. So you're looking at around a 5% earnings yield. But if you go and look at the 10-year, you can get 4.6 risk-free. So is those few basis points of risk premium really worth it as an equity investor right now? That's the other thing that's, I think, is acting as a drag here.
Yeah. Also, Peter, are you able to are you able to speak yet, or I think you just joined? So I wanted to
Yeah.
give him a chance.
Yeah. Can you hear me?
Oh, great. Yeah.
Cool.
Yeah, we're perfect. I just want to make sure we'll be able to pass it around to you here in a minute. But I do want to jump on one point here that we were talking about earlier, which is the yen and the carry trade that's been going on. Craig, I think you've touched a little bit on this on your Substack posts. How do you see that going forward with everything that's going on between the Fed, the BOJ? Give us kind of a little bit of like a cross asset view from where you sit.
Yeah, look, I mean, I think dollar yen is kind of front and center here. JGB yields as well been selling. JGBs have been selling off. Yields have been making kind of generational highs. Dollar yen has been making 40-year highs, and there continues to be talks about when they're going to intervene, when are they going to step in, when are they going to screw over the speculators. But look, I mean, what's really what can they really do here? I mean, one thing that they have that's going on here, a lot of this is largely out of their control, right? I mean, basically, what you're seeing is strengthened dollar broadly speaking around versus not just the yen but versus other currencies. I mean, euro yen hasn't really done a lot over the course of the last 6 months. So it's not just because the dollar has really been rallying. And part of that story is that it is the oil story and the geopolitical and the fact that Japan is a massive energy importer. And so until there is, I think, more clarity about when the war is going to be over, I think it's harder for the MOF to come in and decide to intervene. It would just be like wasting bullets, which is largely what happened when they did it in April and May. And so I suspect we're going to continue to see as long as oil continues to remain elevated, and LNG is a big problem for Japan as well. And then gas prices are starting to move back higher again. I mean, European gas prices are at the highs from back before when back to the early days of when the war started in March. And so I think what you're going to see here is I think you're going to see continued pressure on the yen. And they'll be, the BOJ will jawbone, but they have a meeting next week. There's no expectation for them to raise rates. And so it's going to be hard for them to say they're going to be hawkish when they have a meeting and are not hawkish, right? So my understanding that there's a lot of knockout and barrier positions at 165 and 170. I mean, we'll see. I mean, we could get a larger move here in dollar yen, which I think would be, pretty destabilizing. And that what that means, I think also is that Japan has the ability to slow down the rate by which the yen weakens by selling treasuries, right? And so that's where you get the kind of this negative feedback loop where Japan is selling treasuries in order to slow down the pace of yen weakness, but them selling treasuries or not showing up to buy treasuries at auctions leads to higher yields in the U.S., which then pressures U.S. equity markets and U.S. credit markets and the like. And so that's where you kind of get the highly correlated cross-asset moves, the 1 + 1 + 1 = 10 type trading dynamics that could develop here over the course of the next few weeks. I mean, again, there is an analog back to last or two summers ago when a similar kind of dynamic in play. But at that point, Japan was in a better position to actually intervene, and it came on the heels of a pretty weak U.S. payrolls number that happened on, I think it was August 1st or August 2nd. And so you kind of had the 1-2 combo of worse data in the U.S. that rallied the yen, plus some intervention that rallied the yen. It kind of led to this carry trade unwind that cleansed some positioning, and then things were fine again. At this point, it's not clear we're going to get that type of cleansing data out of the U.S. I mean, I think we do have a payroll number next Friday as well, but expectations in the labor market in the U.S. are remain reasonably good, and so the Fed, as far as the Fed's concerned, the odds of a rate hike are, I think, in the mid 30% for next week. This is what happens when you eliminate forward guidance, right? Under the Powell Fed, we would know full well that they either were or were not raising rates next week. With the Warsh Fed and no forward guidance, investors are not sure what they're going to do. And so it kind of creates this incremental volatility in and around Fed meetings because real money moves based on whether or not the Fed raises rates or not, right? Like not just trading, just like actual real people, real economic actors, need to hedge positions based on whether or not the Fed is going to move next week or not. And so I think that's the dynamic that's in play now into every Fed meeting. So probably look to expect to have more volatility going into these Fed meetings going forward. And it seems like that's something that Warsh is fine with. We'll see how much he's fine with it if we get asset price corrections, into these meetings. But I think that's largely the dynamic that's in play here. And so I'm not really sure what's going to stop this dollar yen move right now. But the BOJ would have to get really hawkish really quickly, I think. And like I mentioned earlier, there is a CPI print tonight in Japan. If that comes in very hot, then maybe there'll be some expectations for a sooner movement. But I'm not an expert there. I don't really know what's really expected, but we'll see what happens.
Yeah, that's a really good point. In terms of like what the Fed's doing, I want to throw it over to Thomas here, and this kind of can transition over to like our next topic, which is where we're seeing the oil markets. We've talked about quite a bit already, but oil's trading at a 98 handle. With the 30-year Treasury, I think, is above 5% for like the longest period since, I don't know, like 20 years or something like that. It's really just staying above. What we typically see is like a reflexive move of marginal buyers from liability-driven investors start to bid at that level. And right now, I guess it's becoming a little bit tougher to kind of push those yields back under 5%. Tomas, I want to get your take on where we're sitting right now as we kind of head into the Fed meeting next week. Where are we sitting right now in terms of expected inflation?
Yeah, I think the truth is that obviously it all depends on what's going on with this U.S.-Iran conflict, and I I get the impression that given the consistency of the daily strikes, I think we're at what, like 12 days in a row, if I'm not mistaken, where
Sounds right.
it it feels like there isn't like light at the end of the tunnel. And I the issue, and we kind of discussed this last week in the sense that when it comes to the energy prices, there is a level at which like the market's going to tolerate it up to a certain point, and then it kind of just starts to like feels like a snap effect. It's not a linear progression, it's more of like a step change. That's how I think of it anyway. And given where the oil prices are now, we're probably at this point ahead of uh, or above the average price we saw in June. And mind you, the peace deal, or the memorandum of understanding that came out in June, was around the middle of the month, and we had a quick reprieve in oil prices, and we had a nice cool inflation print off the back of that environment. And so what we're seeing now is that July is looking like it's actually going to see a premium to the June average prices. And so now it looks like July inflation is going to probably be a bad comp month over month, is kind of where my head is going. And so I really just think that people are kind of getting caught off sides both ways. Um, they were betting on this like longer for or higher for longer. You had the memorandum of understanding. Energy markets fell pretty precipitously. They started to unwind whatever position they had in the face of that. And now we're like right back in that environment within a few weeks. And so, and then of course with this job print this morning, showcasing some unexpected strength, it actually is like almost like a mirror reflection of a job print we saw. I'm not recalling which one exactly, but maybe like a month or two ago, where you had a little bit of weakness versus consensus, and people were starting to see that as, hey, maybe this starts to build in justification for the Fed to maintain a bias ease. And so now we're back towards a labor market as actually a little bit stronger than expectations, and the energy markets coming back higher. Like how are you the case for even holding or biases is kind of falling apart, I think, is how the market's positioned. I still think that Warsh is going to be trying to position things for a hold until something breaks situation, but I think the market's just having a hard time positioning for that.
I wanna pass it around and get everybody's view on kind of like on this topic. But before I do, I'll give us just some quick data on the crude. This will be WTI, but here's the futures curve. So you have the front month, the September 26th contract trading at 92.59. We know Brent's higher than that. December is at $80.30, with June 27 at 73.68. So you do have kind of this backwardation, this steep backwardation that's persists And I think this is on the wake of what Wall Street's been calling this glut expectation. IEA warned in June that a potential U.S.-Iran peace deal paves the way for a renewed supply glut in 2027. So I don't think you're getting too much participation in trying to bid those levels up out further out in the curve. And Goldman's also been saying, I think, for some time that the oil markets expect to swing back into oversupply. But then these things kind of keep happening on the geopolitical side. Craig, I want to get your view. How much should the Fed be worried about, oil, which is something, of course, which sits outside of the core inflation bucket, right? It's by definition excluded. What can the Fed do to kind of keep a lid on oil prices?
Yeah, not much. I mean, they can't print barrels. But I think part of the issue for the Fed is that services inflation, core services inflation, continues to run well above normal. And so when you have core services inflation, that's been sticky, and now you have the technology, which is kind of going from deflation back to inflation, with all these consumer technology price increases and the memory price increases, that stuff kind of does filter in to broad goods pricing. It makes the case harder for the Fed not to react when services prices are firm, core goods prices are firm, and then oil kind of then moves higher. And so it's not as if the Fed is tightening to kind of bring down the oil price per se. It's just that it makes it makes it more difficult for them to ignore the other stuff, I think. I don't know. It's a tough call here, right? You clearly have a economy that is very bifurcated, right? Part of the economy is doing incredibly well, things that are tied into the AI CapEx story, and wealthier consumers are doing incredibly well, and things that are not tied into that, and things that are more rate sensitive, whether it's housing or the low end consumer, are doing quite poorly. And so Fed has likes to say it has one policy tool, the rate tool here, but raising rates is going to make it harder for low end consumers. It's going to make it harder for those other areas of the economy to do better. But not raising rates is going to lead to further asset price gains and more inflation. And so I think Warsh recognizes this, and that's why I think he's talked more about the balance sheet as a proper second tool. And I think in an ideal world, what he'd like to do would be to reduce the size of the balance sheet and reduce interest rates. And I think reducing the size of the balance sheet would help bring down the wealth effect and would help bring down inflation associated with high asset prices. And then bringing down interest rates would help alleviate some of the concerns and issues that the low end consumer is having, and that industries that are more rate sensitive are having. I think that's where he wants to get to. So I don't think he wants to kind of raise rates first when ultimately he wants to bring rates down. But I think I think the long end of the bond market's kind of calling a little bit of BS on that, right? And basically saying, well, you're not serious about bringing inflation down. That's why we're a bit more concerned here. And I think some of the weakness in the long end globally is about reluctance to deal with the kind of structural embedded inflation that's been associated with the AI capex build out. I mean, these Warsh and Williams and others have kind of talked up the productivity gains that'll come eventually from all the AI that gets built out. But really, the capex associated with it now, it's highly inflationary first, and it's just not clear when this is going to dissipate. And so I think it's a tough road for Warsh to communicate next week. And I think that's why you're seeing a little bit more bond volatility pick up into the meeting next week. I think people need to understand or want to understand what his reaction function is going to be. What is the Fed going to do? Are they going to address this inflation now with rates kind of before these committees are all finished up and before they have an ability really to move more aggressively on the balance sheet if that's what they ultimately decide is appropriate?
Big difference between talking about raising rates and actually raising
Right.
rates, right? That's good.
Exactly.
Yeah. Mark, I want to get your take on this discussion as well.
Yeah. So one component that I've been watching closely in services is housing. And that it kind of puts them in a tough spot, because if you get into a point where you're actually beginning to raise rates or even shrinking the balance sheet, you're down a structural buyer at the long end, and that's kind of what mortgage rates are tied to. So then you could start to see that housing inflation begin to shift back upwards. So they're in a kind of a bind here on that stuff, and the goods inflation doesn't help them, because what we'd like to see is to see continued disinflations in goods that we've seen over the last 10, 15 years. But with the AI spend pushing up technology prices, that's going to hurt the consumer too. And then on the oil markets, one thing that I've been watching closely is not just the Strait of Hormuz and what's going on over there, but we've also seen the Houthis in Yemen begin to threaten other oil shipping routes. And I think that's kind of what's your catalyst for that step function gain in oil. If we see this start to spill further out into the Middle East, that's where the real risk lies in my mind for us to see WTI starting to take out some of those highs that we saw earlier in the year.
Yes, it's no, it's going to be really, really tough, I think, really for Warsh to um, try and execute on getting the market to expect lower rates, or at least hold off on interest rate hikes. If I had to guess, what's going on in his mind, and this is something I've shared before, is that I would definitely use ambiguity to my advantage. So the trying to pull forward guidance, trying to not comment and take away as much Fed speak opportunities as possible, remove the dot plots, et cetera, et cetera. I would do that to my advantage, because it does as soon as you start to lead the market, it definitively kind of starts to set the path on what the Fed's next move is, and I think that's kind of a joker card that he can keep in his back pocket. I don't know, Peter, if you want to add anything else, or if we want to jump over to our last topic, which is very, very timely on the clarity regulation.
No, I think all you guys covered it really well, honestly, and touched on all the good points. We can shift over. I know we're getting a little bit closer on time.
Yeah, we are going to wrap up here in about 15 minutes. And Craig, just an FYI, we always go around the horn and like the last 5 minutes and just do kind of like a week ahead, what we're watching for the week ahead. But so it would be great to get your take on that. But yeah, let's jump over to clarity. It's been probably one of the most consequential things happening in our industry in digital assets, and we're getting headlines almost like every hour, it seems like. There's a lot of good stuff happening on X. If you've got the accounts to follow here, it's gonna keep you in the loop. But I wanted to bring in Mark, our research analyst, who's gonna give us a quick rundown on the draft that was released yesterday by the Senate Republicans, right? And where does that sit? And maybe give us an update on what are the roadblocks.
Yeah, so just taking a look broadly at the Senate's text versus the House's text. The Senate's text is a lot more comprehensive. So we have everything from asset classification, we have rules for capital formation, we have the provisions for DeFi, we have a CFTC framework. And then the real sticking point, though, has been this ethics provision. If we look at all of the discourse from all of the senators, whether they're posting on X or talking about it on the news, it's all around ethics. What we have in there right now is it actually covers, is pretty comprehensive. So it covers the executive branch, their spouses, senior officials, the judiciary branch, as well as the House and the Senate. And it has an expiry date of January 20th, 2029, which is the end of the president's current term. So it would cover the rest of this term. The sticking point seems to be on enforcement. Right now, they have the United States DOJ acting as the primary enforcer. They would bring civil complaints for anyone who were to violate this ethics provision. What it seems that some Democratic senators want is they want state attorney generals to enforce on this, or that's what they're saying, or that's the language they've been using. To me, the tricky part with this is that we know President Trump is a very polarizing figure, and then there's been a lot of political polarization over the last, call it 6-12 months. What you can get is you make it a lot harder to make a deal, because the Democratic senators are more likely to reach for more to play with their voter base. So I don't know what's ultimately going to happen with this. They can still revise the text, revise the bill before they bring it to a vote. They might try to expand the ethics provision or maybe change it up a little bit. There was also talk of the expiry date being an issue. They might want that to run continuously. One thing that I do find interesting on all of this is that I find it strange that they're targeting one specific asset class here. I guess now they're looking at a stock trading ban in Congress, but it seems weird to me that you're targeting just the cryptocurrency asset class and not going after all of the other ones that they could be potentially trading. And again, it's largely political, as Trump's disclosed over $1 billion in gains from crypto. That's what's really making this difficult, is that you don't want to look weak to your voter base, and you don't want to give up too much ground. So we'll see what happens in the coming days. If they're going to do a vote on this thing before the August recess, they only have about 2 weeks to actually have the vote. So what we'd like to see really is a resolution no later than early next week on this.
And then, so early next week, what other timelines should we be following as far as getting this from all the way to the finish line, we should say?
Yeah. So because this text does cover a lot more areas of the market than the bill that passed the House, there's going to need to be a reconciliation process. Now, there's a few ways it can go. The House can just accept the Senate's text as written, pass that, and send it straight to the president's desk. The other thing they can do is they could make small tweaks, small provisions, and then they would have to bounce it back to the Senate for the Senate to vote on again. The House will start to leave a little bit early for the August recess here soon, or they'll start to go out of session. So in my mind, what's likely to happen is the Senate will have a vote, and I think it's pretty unlikely, unless the House accepts the text, that we get that bounce back to the Senate before the August recess. The thing to keep in mind is that it is a midterm year, so they'll get back in early September. You really only have until about late September to get that through. Otherwise, everybody's focus shifts to midterms, and then this can easily bounce into 2027. And when that happens, there could be a shift in the balance of power in the House and the Senate that could ultimately, stop this thing until potentially 2029 or 2028.
Yeah, it's pretty big. Tomas, I don't know if you want to jump in here and give your take on the latest developments and what you expect going forward.
No, I mean, I think the expectation, at least for the people who do the lobbying and whatnot, was that we were going to get the text coming out. It was a net a good thing that the text came out with this ethics clause included, because one version of the story was that we would get text and it would just be a kind of a placeholder blank ethics section. And so that was a net positive. The expectation was still going to be that you'd have a coalition of Democrats who were going to immediately push back because they weren't, it wasn't call it a negotiation going into that text draft. And so now they're going to do some horse trading, I expect, possibly with, committee member selections for different regulators that continue to have absences on the commission level, and we're going to see if the negotiation's enough to get enough Democrats in. I think we're going to need 9 or 10 Democrats at this point to vote in favor. But I agree with Mark's point of view that it is right now at a very political stage and it feels very binary. I'm constructively optimistic because I just think that fundamentally this is a much better situation versus the status quo when it comes to building a framework that enshrines a competitive US going forward for crypto. And the ethics stuff, it feels very targeted towards an event that already took place now coming on 2 years ago. So we'll see what happens.
Yeah, I've also remained pretty constructive on it. I think I saw Anthony Scaramucci on CNBC this morning giving his take and really just trying to square things up that, if the pro crypto Democrats, pull out the end, it could set up a pretty nasty kind of political battle as they go into the midterms. And he just speculates that, that's something that they don't want to face. So politically, it's probably easier for them to vote in favor once this gets to the floor. So let's keep an eye and make sure that it gets to the floor. But I think there's also risks from the external lobbies. You got the bank lobby, you've got law enforcement lobbies that are still, I think, trying their part to swing even Republican senators, is what I've been reading as well. So there's just a lot of, I think, it is binomial. It's pretty 50-50 in my book, but I want to break more towards like a 60-40. Peter, I wanted to get your take really quickly on what this type of legislation means for institutional participation, as you sit very closly with the partners and clients that we have on the institutional team.
Yeah, no, I mean, I think it's extremely important. I mean, we've seen a handful of institutions, and specifically with CF Benchmarks and Kraken, that we work with, a lot of the big names in the space, but I think that the lack of clarity has honestly kept a lot of them on the sidelines. There's just, and what we've seen in conversations that you and I have been privy to is a lot of them have aspirations or the willingness to get into the market, but they're not sure if it's worth the lawyer's fees and everything to actually go ahead and launch products or build the infrastructure or onboard certain vendors. I think really I mean, it's extremely important from an institutional perspective that they've been waiting for something like this, and I think that it's extremely positive if it does go through. Just I mean, then because for us and being a registered benchmark provider, it just gives a lot more of these institutions comfort and will honestly allow them to actually invest in the space. And I can kind of, I know we're coming up close to time, but can kind of kick off the roundtable. I mean, if we're ready, like, I mean, that's something that I'm watching very, very closely, just because a lot of we're a heavy institutional firm, so a lot of the people that we've been speaking to for the past couple years, I think that they've been waiting for something like this, so it's very important for the institutional market.
It'll definitely be exciting, I think, to see kind of if you get this through, what kind of innovative products we'll see 6, 12, 24 months from now. I think this is really could be a step
Yeah, you
change in
could see
that.
more staking, more multi-asset, more stable. I mean, you could see a breadth of a lot of like more diversified, quote unquote esoteric type, even crypto products once people get more clarity around it, which I think is very exciting.
Yeah. All right, so we're wrapping up here. We got 4 minutes left before we hit time. I do want to go around the horn and get everybody's view on what's top of mind for next week. I'll start things off with Mark. Why don't you give us the first go around, and Craig, maybe we'll save the best for last with you.
All right, yeah. So top of mind, first thing I'll be watching is for any type of vote on the Clarity Act. The next thing is we have the FOMC meeting next week, so we'll see what. I'll really be looking at the press conference, specifically the Q&A there, to see what Warsh's answers are to everything. And then we have some PMI flashes next week too. That'll be good as a kind of our leading gauges for activity and inflation.
Tomas, you want to go next?
Interest rate decisions, whether we get any kind of like weekend escalation when the markets are closed, trying to put a taper on this, like 2 weeks of straight strikes. I'm also very interested in seeing progress on clarity, as Mark's mentioning. I think we're going to get a lot of headlines over the next several days as people negotiate. And I'm also taking a very close eye on the day-to-day flows in the Bitcoin ETFs. I know some of you have highlighted this in other channels, but we're going on I believe we're pacing towards the third straight week of net inflows after a very rough period of outflows. They're still very modest, but it's perking up, which is nice to see.
It is nice to see. I even saw this morning Eric Balkunas tweeted out that futures volumes are getting picked up here by Beto, which of course was a pretty significant launch in the last crypto cycle, which is a futures Bitcoin ETF. So those are picking up as well, and the flows have been positive. For things that I'm looking out for the next week, I obviously FOMC is a big deal. For us, we also just need to really be on our X accounts watching all the news that comes out of DC with the Clarity Act. That's going to be very, very important. Flash PMIs are on Friday, so that's something to kind of tune in for the U.S., Eurozone, and Japan. And Craig, you've opened my eyes to following this sequence playbook that you outlined earlier. We'll record this episode and we'll put it up on Spotify, Apple Podcasts, so anyone that's just joining can listen in. But I'm going to be following, I think the inflation print in Japan tonight, because I want to see, this reflexivity across with the funding currency yen. see how that print comes in. If it comes in hot, see how that impacts rates vol, everything like that. So yeah, really a lot of stuff to follow. But no, I'll pass it over to Craig to finish things up on what's top of mind for him.
Yeah, I mean, you guys mentioned a lot of the catalysts. Next week's kind of a big Super Bowl for macro. I mean, between the Fed meeting, the BOJ meeting, but also Meta, Microsoft, Amazon, Apple, all reporting. To your point from earlier, at some point somebody is going to announce a capex slowdown and is going to be rewarded for it. Keep an eye on Meta for the potential company that comes and decides to slow down the capex and get rewarded for it. I think in an environment where we finally get that kind of headline, the implications are going to be massive. I think that kind of will put a damper on this momentum. We continue to see the flow into semis and into memory names. We could get a vicious unwind of that trade again, where semis would start to underperform, and let's say all the market cap goes into Meta for a little bit here. But given positioning, I don't think anyone's really really quite set up for that. So keep an eye on that for sure. And then all the geopolitical stuff. I think the markets are expecting tacos, right? And the markets are always expecting tacos from the president. And so it's not clear exactly what they're going to be, or are we at the levels and risk assets where he can deliver them, or that he cares. So clearly the weekends are interesting in that regard. But he said while we were on this call that he's deciding about maybe doing a larger than ever attack. Escalate to de-escalate, maybe. We'll see what happens. But I really appreciate you guys having me on. It's been a lot of fun. Thanks for the audience.
Thank you. I mean, this was just a fantastic discussion. Again, if you've missed it or just joining, don't worry. We're gonna record it. We'll put it up on our podcast stream. Thank you again for joining, Craig. Thank you everyone for participating. Thanks to the audience. It was a lot of fun. Always do your own research and be sure to trade safe. Until then, we'll see you next week.